Hello and welcome to Closing Trades right here in 18 Hour with me, Asha Faridi, Nikunj Dalmi in the studios. And what a quiet market this is turning out to be. Much unlike yesterday when we were quiet for the large part of yesterday's session and then saw a late trade pickup, but no signs of a pickup just yet. Just been circling around that 19,400 for the large part or better part of today's trading session. In bits and starts, of course, there are an odd cap goods, telecom plays, infrastructure, realty, which are holding out. Adani names once again are propping up in the green. Look at the tear that you're seeing on a BHEL, for instance. That stock is holding higher by 8.5%. GMR Infra for a second consecutive day has been very, very strong. And you are seeing some decent moves come in from a Tata Com as well. Having said that, many large caps continue to be under pressure as well. You're not really seeing much of a move sectorally by pharma, by oil and gas, or for that matter, even technology, which is very, very sedate in today's trading session. So yeah, pretty much a no-go, and you're wondering where the next cue for the market is going to come in from.
It's not bad if you just move away from the Nifty, because the Midcap index today is at an all-time high. And that is what the exciting part about the market is. The breadth is, you can look at the names which you would say in the F&O market and say, okay, these are the ones which will make trader and HNI investors heavy. BHEL, 10% higher. Why? One small order, 10% higher. That's BHEL for you. You got L&T Finance, again, very large, very liquid, 4% higher. Mahindra & Mahindra Finance, 4.5% higher. Escorts, 2% higher. Hotel stocks, GMR. So it's not like a hollow market if you really move outside and just shift focus slightly. Don't look at the center, don't look at the Nifty, don't look at the Bank Nifty. Slightly off center, mid-cap stocks, yes. Small cap stocks, yes. So it's not a bad market. And frankly, if you ask me, the market has the ability of the market to shrug off bad macros, bad flows, everything has pleasantly surprised everybody.
Oh yeah, absolutely. In fact, I'm just looking at the individual movers as well. Look at Indo Amines, for instance. After GPCB revoking that closure order for the Vadodara plant, that stock is actually holding up a good 9%. There's a car trade wherein Nomura has maintained a buy, target price of 678. That stock is pumping up in trade. Or for that matter, even Oro Pharma, wherein Citi has downgraded it to a sell, attributing to the kind of run-up that the stock has seen year to date. But at the same time, they've upped their price target as well to about 750, though the stock is a little bit under pressure. Adani Power, once again on a tear, up 4.5%. They're targeting about 21,000 kind of, over 21,000 megawatt capacity by FY29. The target, of course, includes that 1,100 megawatt inorganic capacity as well. And they're also saying that the net senior debt is seen at 26,690 odd crore rupees in FY24, which is a little lower than what the market was earlier anticipating. That said, a lot of other stocks as well which are holding out in trade. Bharat Forge continues to clock in new high after new high. After yesterday's phenomenal move, another 2% up in the green for this one. Nomura is maintaining their buy with a target price of 1157 now on Bharat Forge. That stock already a 4-digit counter now. GMR Infra, L&T Housing Finance, United Spirits, a lot of the broader market contenders are holding up while the Nifty is completely sedate. But Kunal, shall we not talk about the Nifty, talk about the mid-cap index?
No,
Will the Nifty remain quiet for some more time?
In fact, today, actually, for the first time in the last so many weeks, we are seeing some negative signals emerging on the index. Okay. So it's not just the price movement, but on the indicator fronts, many of the indicators have started to get back into, they went to a neutral territory, positive to neutral territory since the last 2-3 weeks of this market correction from 20th of July. But for the first time today, we are seeing the indicators come into that slightly negative territory or breaching that neutral territory for itself. So that could probably be a point of concern. The other way to look at is, two important data points. In the morning I was flagging off that there was a slew of short covering in terms of open interest. Now, if such a strong short covering of 10%, 15% happens into the index, we expect the index to propel on the upside with a second round of short covering. But we've not seen that happening today for the Nifty as well as for the Bank Nifty. And the most important part is the premium for the indices are shrinking, and we are almost at a discount on the Nifty futures. I don't remember last time we've actually seen discount in a running month for the Nifty in the last, I think, 5-7 months at least.
I've not seen this year only.
Yeah, for the
first time
in a running month. Yeah. In a running month, we've not seen the index into a discount.
No, otherwise you've not seen the index. I mean, Nifty futures have not come at a discount this year itself. I mean, 100 point was the average.
See, on the expiry week, we tend to get into the discount. But one week, I mean penultimate week towards the expiry, I've not seen that happening phenomena.
So if there is a discount, it means that the traders are of the view that I want to pay less for a long position. When you want to pay less for a long position, you essentially are bearish on the market. That is what we should infer, right?
Yeah, so basically carrying long is more profitable because then you are, if you're rolling over, it becomes, you buy the next futures at a discount. But markets generally don't, go into the favor of an easy trade. And whenever we see something which is in favor completely of bulls, we tend to take a contra position.
Actually, 19,400 is still there. It's not that you've gone below 19,300. Naresh, Kunal is for the first time making a point that you got to watch your steps. Do you think it's time to watch your steps?
So in terms of premiums and discounts, although we do not have large dividends as such, but June to August is a period of time where there are a lot of dividends on the stock which does not get adjusted in futures all the time. So the September future is still at a 80 to 100 point premium. So for now, it is more like the market is not going anywhere. So I would not take a decision purely on the, premium or a discount, because we've had periods of 150 point premiums and we topped out in the next, 5-10 days also last time around. So the view is simple, let the prices confirm. And for that, it is 19,600, 650 and 19,250 to 300. Till the time we don't go beyond this, we are still stuck in a range and the broader market continues to do well. And it's not just the small caps or micro caps doing well. You have the mid cap index getting higher. You have the small cap index getting higher. Even the Nifty 50 equal weight or the Nifty total market cap or Nifty 500 has not seen much of a decline. It is purely because some of the heavyweights on the index have zero trend. So if I add up HDFC Bank for almost 12 to 15% of the index, you have 10% Reliance. Then you have another 5-7% coming from ICICI Bank, and then the whole of IT. So you have almost 40 to 50% of the index which has zero trend and almost at the same prices. So till the time we don't get one leadership stock on the downside or on the upside, we are in this zone of 300, 400 points. So would wait for price action to change to shift stance. For now, continue to focus on the broader market.
Ashi Anand joined just now. Let's take our conversation forward, understand what he makes of the current market setup, where is value in the market and how is he investing. Ashi, great to have you in ET Now. Thank you for joining us. Let's understand and let's start with the market construct. What is your view and where do you think we are headed in the near term?
So, thanks a lot for having me. So just in terms of the market construct, I think largely in line to what you guys have been discussing on the channel. What we have had is a fairly strong move that we've seen over the last few months. Right now, this has happened on the back of interest rates kind of peaking, inflation peaking. And that was a clear headwind for the market, which got removed. And you saw the big move happening off that. Now, with this move, valuations are no longer necessarily cheap. And especially if you're looking at the core large caps, right? You still have certain clear headwinds for kind of growth. The global economic environment is clearly one headwind. Consumption is still slightly kind of weak. And inflation and interest rates, while having peaked, aren't yet reducing. So given that kind of construct, it doesn't really lay the foundation for a very strong bull market until some of these headwinds don't go away. But that said, what we are very clearly seeing is India is starting to look extremely attractive from a longer term perspective relative to all other major global markets. So you're seeing this in terms of the interest that you're seeing from FII close, I think over $15 billion so far this year. You're clearly seeing India becoming more attractive as compared to China has a number of issues, right? So it's becoming very difficult for people to allocate money to China. Europe is relatively weak. The economic outlook out there is quite low. So India is in this context benefiting a lot, and this should also help prevent the markets from falling too much. So I think at least when you're looking at the larger cap indices, you're probably going to be in an extended period of a bit of a range-bound move until you don't see either growth starting to kind of come back and clearer signs of growth coming back, or there's no kind of major negative kind of event that could happen that could force a larger correction. And I think the one thing that we are watching out from that perspective in terms of a potential negative news flow is in terms of some of the developments that we're seeing happening in China, especially on the real estate side.
I wanted to pick up on the point that we were chatting about when you were last on ET Now. Your PMS strategy, wherein you have invested exclusively in some of the platform companies. Now, most of these stocks, barring a few like Nykaa, etc., have already doubled from their previous lows, right? Do you think a large part of the rally is behind us, or do you still find these stocks worthy for long-term investments?
Aisha, so we're actually extremely positive about this space. We've actually, the way we look at it is it's a quasi-private equity strategy that we've launched. Our timing ended up being very good. We launched it pretty much close to the bottom. But if you're effectively just looking at what makes us so confident of long-term value creation in digital platforms, market capitalization growth is always driven by business growth. These are the fastest growing businesses by far. So if you're looking at a kind of digital platform strategy, we have investments in companies like Paytm, Nykaa, Zomato, Policy Bazaar, etc. These are the fastest growing financing companies, fastest growing food delivery, fastest growing shopping spaces. So growth is something which I think is very clearly understood, and there's very clear value migration happening towards this particular part of the segment. We built long-term models, and if you just look at the penetration rates in India, look at certain underlying dynamics in terms of the foundations for longer-term growth, the ability for these companies to continue to compound revenues at over 25% from a longer-term perspective is very clearly there. The misunderstanding, according to us, in terms of the listed market space is with relation to the longer-term profitability of these companies. What people don't necessarily understand is the sheer quantum of current expenses that are really just short-term in nature. As in, these expenses are primarily linked to the current hyper-growth phases that these companies are on. There are four distinct phases of the evolution of a digital platform. When you're in stage 1 and stage 2, you're trying to change consumer behavior, and there are very large amount of expenses to drive this change of behavior. As consumer behavior gets changed, and you're starting to see this, you can actually ramp down these costs quite significantly. And someone like a Zomato introducing delivery fees, if you're seeing someone like Paytm earlier used to have cashbacks, there you no longer get those. A lot of the costs that were involved in trying to ensure that consumers participate on a platform, those can be rolled down quite significantly. And also various monetization levers can be, there are various new forms of monetization that come up. Now, this can lead to very healthy profitability over the longer term. And according to us, a combination of much above industry growth along with a shift towards profitability should lead to very attractive value creation.
Right. Sure. Ashi, hang in there. Lots more to talk about with you, but we will slip into a very quick break with news that we're still pretty quiet in the index, and it's the broader market once again, which is extremely lively.
Kunal, you cannot take your eyes off from BHEL. I've always wondered why this stock is going up, but my wonderment can remain wonderment for a long period of time.
Small wonder.
But I've been liking the stock, and I think it looks very attractive on the charts. I remember, I think post results, the stock was just staggering at the 100 mark. There was a touch and go movement towards 103, 104 for BHEL. Then it came down towards 95, 96 odd levels. But then, the last few days, the stock has been steadily seeing a buying. Today, the stock has seen a huge breakout. This is, I think, a major multi-year breakout for BHEL, crossing that 110 odd levels. And for the first time, I think, if I remember, I think the stock was also in upper circuit of trying to break past about the 10% level. So again, a strong breakout for BHEL, expecting this up move to continue, as well as expecting this to be more of a multi-month uptrend, not just from a short term.
There is a big spike in Bharat Forge, and guess what? We spoke to the management over the weekend. We'll play an excerpt out, and the Bharat Forge, the problem has been, it's been a very deeply cyclical business, because it started as an auto component company. They were making components for trucks and cars. Then they started exporting. And when they started exporting, there is cyclicality which came into their business because of Europe, 2008, COVID, and then what happened because of war between Russia and Ukraine. Then they started diversifying. They moved into industrial design, and that also was cyclical because the capex cycle is never linear. Then came the third leg. They moved into aero, and now defense, which is 10% of the business. Now in defense there is no cyclicality. In defense you always have a linear move. India will need more defense. You need to modernize. You need to service. And the mainstay for Bharat Forge now, what the management told us, was that they would be getting a lot of business from maintaining some of their drones and the trucks and the other defense equipment what they're planning to do. Let's hear out the management, Amit Kalyani, on the way forward for Bharat Forge. One number which markets and shareholders always look at is ROS.
Yeah.
Your ROS has fluctuated in last couple of years. Is that largely because of investments?
It is because of investments. And please understand, it took 12 years for us to incubate our defense business. It will take less than that for our EV business. It has taken less than that for industrial. Our overseas businesses have taken longer because nobody could anticipate COVID and what it has done. But our ROC targets are well in excess of 20%. And I'm confident that by 2025, we will be well in excess of 20%. 22, 23% or so.
So does that also means that you're assuming your global business will come back? It has to normalize.
It will come back. Of course it will come back. Our European business will be profitable this year, and our US business will head towards profitability by the end of this year, and by next year that also should be profitable.
So what Bharat Forge has achieved in last 5 years, you're likely to achieve that in next 2 years?
I hope so.
Because for you, all your businesses now are filing full cylinders, you're ready, capex is done, and now it's really operating.
Capex is done, but we also need to do more capex, as we announced in
the
last
quarterly
call.
Numbers, yes.
We'll invest slightly over 1,000 crores in the next 24 months or so in both our conventional business, in EV, in aerospace, and in industrial.
What are you doing to increase the moat around your business? Good companies always focus on that. How can they make the company more distinctive?
So we are increasing our moat by doing 3 things. One is, in our existing business, we will become the last man standing, which means the highest quality, the highest capability of engineering, most competitive cost-wise, and unmatched financial strength. In new areas, we will be lean, mean, and hungry. And we will use technology to drive our business, and we will continuously reduce cost, and we will use technology to reduce cost. And we have an amazing technology platform that we have in place now, which is going to help us increase our productivity quite dramatically while reducing cost. So that is what we will do to increase our moat. And the last thing you have to do to increase your moat is increase your customer affinity or your customer relationship, and that has to be through engagement, bringing value to your customer, and that is something we do through technology, and that's what we do in this building and the next building.
I want to get in your views here. What is it that you're making of some of these companies which are in a transformation stage, if I can call it that? Prime example being a Bharat Forge. Ashi?
Sorry, hey, yeah, I didn't realize you'd asked me the question. So, I think the one thing which is very interesting when you're looking at a lot of these auto anchors and companies such as Bharat Forge in the transformation phase is defense is clearly a very, very interesting opportunity for these companies. What you are looking at is India has the largest import bill of defense equipment in the world. I don't know if a lot of people know this, but we're actually larger than the top 2 or 3 other countries combined. There is a very strong strategic need to indigenize defense because a lot of our defense was Russia dependent. And as Russia is going through various troubles, you need to kind of de-risk from that from a strategic perspective. You're also having issues around geopolitics with what's happening with Pakistan, Afghanistan, China also becoming a lot more aggressive. So you're in a need to increase defense spends, and you also need to de-risk, and therefore you're seeing a lot of traction in the Make in India program. Now, this is very beneficial for both PSU kind of defense peers as well as companies such as Bharat Forge, etc., which are starting to build out their defense practices. I think for Bharat Forge, this is also particularly important given the fact that they do get a reasonable part of the business is still dependent on internal combustion engine kind of lines of business. And that is something which is at risk as EVs increase. So they do need to kind of find new lines of business, and I think defense becomes very attractive from them from that perspective.
What is your view then on these richly priced defense stocks? When I say richly priced defense stocks, Mazgao, Kochi, HAL, suddenly they're commanding P multiples which are even north of ABB, Siemens and Thermax.
So it's actually quite difficult. Honestly, it becomes very justified to justify those kind of valuations. But what becomes a little difficult is in terms of how lumpy these businesses are. So HAL, for example, the Tejas program is extremely important. Now, if they get incremental large orders on Tejas, you can actually see a very sharp, sustained up move in revenues. And from a longer term perspective, you could potentially start justifying some of those multiples. But on the flip side, any kind of weakness happening on the Tejas platform and the whole story could really go for a toss. Some of the shipyards are very dependent on specific kind of orders, and some of these orders are so large that if you get it, you can really justify some of these multiples because it can lead to a ramp up of revenues and margins, which kind of do justify it. Now, what's happening is in terms of the current valuations, you're really factoring in all of the positives and assuming everything plays out ideally, and you really aren't justifying any of the risk, which is why we at least are staying away from these pure play defense contractors, which have larger lumpy businesses. I think the only stock we have in our portfolio is Bhel, Bharat Electronic. Out there, it's the orders are much kind of smaller and it's a lot more diversified. But these pure play defense PSU companies, it's a bit of a 0-1 in terms of how some of these orders play out.
Sure. Ashi, great to have you on ET Now once again. Thanks as always for dropping by.
Thank you so much. It's a pleasure.
Okay, that's the word coming in from the House of Valcreate Investment Managers. Let's take stock of what the market is up to, and still a no-go, at least at the index level. We're still flat, though a little bit of a drift down is what you've seen from where we were just about half an hour back. So absolutely flat right now with a negative bias at 19,395, a downtick of about 22 points on the futures. What's putting pressure? BPCL, iShares, SBI, TCS, Bajaj Finance, FinServ actually, I stand corrected, ICICI Bank, TechM. Some of these stocks are caving in, as are others like in Infosys, ONGC, Reliance, and now even Indusand, Tata Motors, as well as Wipro. But Kunal, let's get some closing ideas on that note.
So Bharat Forge is something which looks attractive. Now I think the futures as well as the spot is trading above the 1,000 mark. So would be something from an interesting trading perspective. We'll be looking to buy, expecting the stock to move up towards at least 1,040 to 1,060 over the next couple of days.
Right. Naresh, what about your closing ideas?
So that would be a buy on LIC Housing, which is setting up for a multi-year breakout. The stock has multiple tops around 440 levels. We've come to 420.25 today. Plus the stock is ex-dividend, so closer to that adjusted level, it would be 430 to 435. If that breaks out, could see a big move. So looks positive for a medium-term outlook.
Okay, let's take a very quick break on that note. When we come back, we'll map the last half an hour of trade this afternoon. But here's a snippet from our special edition called ET Now on the Go. We caught up with Bajaj Auto's Rakesh Sharma at their Pune headquarters, where he lays out the growth roadmap for the two-wheeler major.
A lot depends on the economy. But if you just compare FY23 with, let's say, how we exited in Q4, how Q1 performed, and how Q2 is shaping up, we can already see that the single-digit negative which the industry was in has now moved into single-digit positive. So Q1 was better than Q4, and July and August are seeming better than Q1. So it's still single-digit growth, but there is a point of inflection which has been navigated.
There's a very interesting change in the automobile market, and I'd like to draw a parallel here. The SUV market, it accounts for more than 50% of the total sales. The typical Maslow hierarchy in India was migration from cycle to motorcycle, motorcycle to a small car to an SUV. But the first time buyer is not buying a cycle, he's not buying the motorcycle, but he's buying a SUV. Is there a change in the way how patterns are emerging now?
Well, even today, in a lot of these in a lot of the motorcycle segments, almost 40 to 50% buyers are first-time buyers.
Okay.
You know, whether you're talking about the entry level or whether you're talking about the top end. So there is a lot of fresh influx, which is a very good thing. A very important contributory factor is the penetration of retail finance, which used to be a few years ago only 40%. But with all the digitization and all the initiatives of the government around Aadhaar and all that, the ability to take risk on credit has got vastly improved. And penetration of finance, retail finance is now almost 76% in motorcycles and 90% plus in three-wheelers, organized finance I'm talking about. So all this has facilitated a movement upwards because everyone, you know, wants a better life, wants a better product, wants a better proposition. And that's getting, and as soon as you combine that with purchasing power, whether through retail finance or directly money in the pocket, you see an uptrade trend which is there. And that is what is playing out even across the motorcycle industry. If you see if you divide the motorcycle industry into two halves, the 125cc and above and the 100cc segment. And if you rewind 5 years back, you will find that the 100cc segment 5 years back was almost 60% of the industry. Today, it is about 50%. And the 125cc plus segment was 40%. That has also become 50%. So this is just volumes in terms of margins and revenue. It is now the dominant share of the motorcycle industry. And that signals two things. One is that there is a upwardly mobile customer. And secondly, I would say that at the very bottom of the pyramid, that customer is very weakened after COVID. And they have not been able to come back to the consumption cycle. They are not still impacted by retail finance. Doesn't penetrate them. So that the very bottom of the motorcycle industry has fallen. What has gained is the middle and the top.
You know, I was a bright student.
Just popped up and right dropped there. What is the meaning of this, Kunal? You fell, you recovered, and you're falling again. This is sign of weakness, right?
Yeah, sign of weakness. And I think the more, so what's actually happened is the Bank Nifty is outperforming. But I think even the Bank Nifty has gone to that negative territory. It's down some 30-35 points so far. The premium is falling for both the indices. I think that's a bit of a concern.
So in cricket terminology, don't bat on the front foot, go on the back foot.
Yes.
If at all, defend now.
See, that's exactly what happens because, you know, after 2 days or 3 days of a bounce for the index, there is all the more fervor and possibility that to carry on the long positions or try to expect that this could be a bottom for the index. But then after such kind of signals which happens, we tend to reduce the positions rather than increase.
No, I'm not I'm not aware of the Chandrayaan terminology. I would have used that for cricket terminology.
Hard landing, soft landing.
But
I hope it's not a hard landing. I hope it's a successful soft landing.
You know, I was just making my notes and it's just look at it. I was just making my notes where I was writing that at the beginning of the year, what was the term which we used to describe US economy for 2023? Mild recession and soft landing. What are we staring at? We are staring at a mild recovery and no recession and uptick rather than any kind of a drop.
Yeah.
So the outlook has changed and that explains why markets are still holding on. Devang Mehta, good afternoon.
Nikunj, thanks for having me on the show.
What are you telling your clients to do? Bat on the back foot or front foot?
I think that's a good question. Probably my sense is that front foot will serve you a little more purpose than playing on the back foot. And why I say that, because yes, market will definitely take some pause after such a huge rally that we saw since March. It was virtually a rally, one-sided rally. There had to be some gravity Nikunj to the proceedings, and that has come. The reason can be the excuse can be any sort of a reason, be it US yields, be it inflation still not under control, the narrative on interest rates and inflation. But more importantly for India, I think revisiting the earnings season, which just got over, say, 7, 8, 10 days back, I think that objectively, a lot of analysts and a lot of people like us are going back to the drawing table and looking at the earnings picture, looking at the re-rating had already happened, whether there is sound earnings which has come in, whether the earnings are in line, what the management has commented over the near future, and what the festive demand as well as in India, macros are absolutely not a big problem, unlike the other parts of the economy which we were talking about earlier. So my sense is that one has to probably bet on front foot. Yes, there can be an approach where you stagger out your investments over the next 2-3 months, but you have to be always on the lookout for those sectoral and thematic ideas.
Okay, when Kunal and everybody thought, Nuresh didn't think like this. Kunal, you only thought like that. Markets have recovered. See Nifty in the green.
Bank Nifty is 48 negative now.
Nifty is recovered, like 2 points up. 2 points up from when we discovered last. Nuresh, what's going on in your assessment?
So, see, we look at Nifty, but if we look at the weightages, even in the Bank Nifty, HDFC Bank and ICICI Bank both are silent. It's not, HDFC Bank has been for quite some time. But if you pick up the chart for ICICI Bank for the last few days, all you see is plus minus 5-10 points from that 950 mark. So if you don't have a trend in any of the stocks, this plus minus 50 points flips in the day is something which we just cannot regard. So the only thing which comes down to the fact that nothing is happening on the negative side on the broader market. We are continuing to see stock specific move. So it's just the time to wait. Markets tend to consolidate, and this is that sort of a consolidation where it's just not going anywhere. So a lot of stocks are just at the same places.
And it's quite intriguing because, the rest of the globe has had actually a good day. So I was just looking at the Asia rates. Japan recovered about 1%. Korea, Hong Kong saw a move of 1%. And even Shanghai finally, after a quiet start, picked up in the green and managed to close nearly with a 1% gain. Europe has started off on a very strong footing as well. Some of the, earnings have been very, very strong there. So DAX, FTSE, CAC. In fact, CAC is now up over 1%. Even the broader index like a FTSE MIB, Stock 600, they're seeing some phenomenal moves there. But our markets are quiet as they may be. And I think the key is, like Kunal was highlighting, look at what's happening within the individual banking names, because there's a sudden drop in the last few odd minutes or so. If you look at HDFC Bank, that's now fallen 0.5%, and you can see the drop came in just the last few minutes. Similar is the price action for an ICICI Bank as well. That steep drop. SBI, of course, was an underperforming stock from the word go, but right up pretty much at the session lows, 0.5% of a downtick coming in there too. And yes, similar is the price action pretty much across the banking pack. Naresh, what do you do with the Nifty Bank?
So as of now, the view is bullish. We keep the stop losses at the recent low on the Nifty and the Bank Nifty. We are seeing a reversal in the global markets as well. None of the risk parameters across the globe are turning around. So as of now, it's a stop loss below 43,500. Accumulate the dips and be long. Same way, 19,250 is a stop loss for the Nifty as well. So positive on it, but more focused is, if one has to look at it, better is to go with stocks. There are stocks breaking out. There is a federal bank nearing a breakout. There is a RBL bank which still looks strong. IndusInd. So you're seeing the smaller banks doing well. Even the small cap PSU banks have done better than the large cap ones. So the view is positive. Add more on the way up above 44,200, 300 levels.
OMC is to provide additional incentive of 3.7 litre on ethanol produced from damaged food grain and maize. Now, what does that mean? Let me try and break it up. When the ethanol policy was announced, ethanol policy had two basic pillars. One, that government, and in this case OMCs, they will buy from ethanol producers at a set price, and that would be a multi-year contract, and they would be supplied with raw material, in this case which is damaged food grain or food grain, at a subsidized price. Then comes the big inflation in wheat and then also in rice. And then suddenly the government came out with a directive that ethanol production in India will have to be done where the ethanol producers will have to buy them from the open market. Then, of course, ethanol producers were losing money. They went back to the government, and now another incentive has kicked in that OMCs will provide additional incentive of 3.7 lakh to ethanol produced from damaged goods. Not too many companies are there. I think there is Gulshan Poly, Praj indirectly would be there. I think there's Bhatinda Chemicals. A couple of very small names are there in terms of what companies would do. But Praj is an indirect machinery beneficiary. Gulshan is in this business, and I think Bhatinda Refinery or Bhatinda Chemicals, one of those, they are also in the same business per se. The spikes I think are there, but again these are very illiquid names. Meanwhile, this is bad news for OMCs. Why? Because if food grain prices go up, they are subsidizing. If oil prices go up, they have to be subsidizing, which means for rest of the whole time, they're only subsidizing.
They're always compensating, yeah. And you can see quite a sharp reaction. Of course, this is source-based news. Maybe we should get in our reporters and try and do a link as well and find out more details on, when could this move be applicable. But let me quickly take it across to Sharad and find out what the buzz across the dealing rooms are. And what are the stocks, Sharad, that's on everyone's radar this afternoon?
Well, yes, we have been speaking with dealers, and in focus we are having Engineers India, and looking at the stock, the volumes have been very strong, coming at almost 3 times its 20-day average, and the dealers have said that in certain counters HNI buying is still being seen. Now do remember the stock is at its 5-year high levels, and that is something to watch out for. But do remember the important triggers going ahead for the stocks is especially expected that a major oil and gas order would be coming in for the stock, and also the company recently won a large order coming in from the ONGC segment, and the company will be also focusing on the new age segment, and this includes the names of biomass, hydrogen and biofuel. So that is what the street is actually bullish on, and even the brokerages have recently given upgrades to the stock, and they have also stated that the company itself is having a strong order book, especially coming from the petrochemical segment.
Okay. Devang, which is your favorite PSU stock? I never thought, couple of years ago that I would ask any guest that do you like anything in PSU, but right now that is the most common question. So which is your favorite PSU stock minus banks?
So ideally, to be very fair, not considering many of the PSUs as a buy candidate right now. Yes, you are right. Most of this had a dream run. Companies like REC, PFC, of course, I'll not suggest it as a buy or a recommendation. But these are some companies which had deep value inside them. There was a dividend yield play at work. There was energy efficiency which was going to be established in India, and the SEB's problem was probably going to be solved. Of course, taking the liberty of talking about bank, which you said, I can't. But yes, something like an SBI probably. Again, as I said, not a recommendation, but State Bank, seeing the turnaround that all these banks had. And yes, we are going to go through a big capex cycle, big consumption boom, and what better proxy play than top large private banks and a couple of PSU banks. I think that is where a pure next to 3 year a little bit of value and a little bit of growth also lies. Otherwise, yes, most of this defense stocks, most of these companies which are into defense arena, as well as these companies into railways, they seem to have a good time. So railway capex has been almost multifold over the last 3-4 years. That has increased so much that something to do with railway capex. Yes, one probably can look at it. The way these trains are revolutionized, way the electrification has been done, signal systems. I think most of these themes have been played. But yes, there can be certain decent candidates over there.
Okay, let's just address a piece of news that we were just highlighting, the fact that OMCs may be providing an additional incentive of 3.71 rupees per litre on ethanol produced from damaged food grain and maize. In fact, Somit, who's actually picking up this buzz, joins in for more on that. Somit, what is it that you're picking up from your sources?
Well, this announcement is coming in beneficial for companies like BPCL Industries, Gulshan Polyols and Global Spirits. Now, what oil marketing companies are doing is that announced an additional incentive of 3.7 rupees per litre or ethanol produced from damaged food grains and maize. Now, with this additional incentive, the total incentive that they will be giving for ethanol produced from damaged food grain would be around 8.46 rupees per litre, and on maize it has been increased to 9.72, and both these rates will be applicable from the 7th of August. Now, with this additional incentives, oil marketing companies are now expecting their vendors to provide the maximum possible ethanol to them to achieve the ethanol blending target. Now the blending target is at around 25%, and as of July 2023 the companies had a blending of around 11.9%. Now if you remember, on 7th of August the first additional incentive was provided of around 4.7 rupees on damaged food grains, and on maize it was around 6.01 rupees, and today additional incentive has been announced which will be applicable again from 7th of August. Now because of this additional incentive, the financials of these companies would again be profitable. Now earlier there was supposed to be losses for these companies because of the increase in prices of damaged food grains and maize, and that was because FCI had suddenly halted additional surplus, had halted providing surplus rice to and additional food grains to these companies to produce ethanol. Now given that additional incentives are coming in, the financials of these companies would again be profitable on the back of these incentives that they will be getting.
Right. Okay, that's the word coming in on what exclusive sources are now telling us and how it's impacting OMCs. In the meantime, Devang, before we let you go, just wanted to understand, what is the house call right now? What are your biggest overweights and underweights in the market?
Aisha, I think the biggest positive that we draw out from all this is that capex has come back for sure, be it government capex and of course followed by private capex. Importantly, sectors like BFSI, which are beneficiaries of not only capex but also consumption and credit growth, is one of the favorite sectors to be in. Yes, I know it's a crowded trade, but banks had a good round of correction and consolidation in the past couple of months. I think that is one sector to go to. Second is clearly auto, which has come up with good set of numbers. Not only the margins have expanded, but the demand scenario as the festive season comes in also is a good medium term type of an investment opportunity. Auto as well as auto components, and followed by something in capital goods and cement. I think this sector as a overall, be it building material, be it cement, be it capital goods, this sector probably is in sort of a next 3 to 4 year type of a structural bull run, where be it paints, be it adhesives, be it cement, most of these companies will come back to the fore, and the demand probably as well in the large cap, mid cap and the small cap space as well. Most of these companies will tend to become either emerging market leaders or market leaders.
Well, I just want to go back to a very simple question, Devang. Everybody likes banks, right? It's a sector which is growing. It's a space where problem is not there. But in this year, when we've had a grand comeback in the markets, FIs are back, domestic investors are back, mid-cap index is at an all-time high. The bank Nifty for the year is flat. Why is that?
Yeah, I think Nikunj, a very good question, very relevant question in the current setup. See, what we have seen over the last 6-9 months, and particularly this year, to be very precise, 7-8 months of calendar year and 6-7 months of financial year, I think it's clearly more a sector rotation which we have seen. Right, and earlier IT used to do well, and then followed by banks, and then suddenly cyclicals came to the fore. Domestic cyclicals also started to do well. So I have not seen a sort of a rally wherein all the sectors out of your Nifty has done well. Though the broader markets would have probably performed very well, as you rightly said, mid-cap index at a life high, a small cap just a kissing distance away from that. Most of these companies in the broader universe have done very well. I think value lies outside of Nifty as well. There are many companies in the next Nifty or even below that in BSE 200 where I think there is a lot of value emerging. So you're right saying that probably this in the last 6-7 months, bank Nifty would have been flat. But yes, you need to buy into businesses which have not sometimes done well over the last 6 months, 2-3 quarters. It had ran ahead of expectations, and I see this more as an opportunity in adversity, in terms of adversity in prices, not even in terms of macros or micros. So numbers were good. Most of these companies are enjoying the fruits of credit growth. Yes, probably they were a little ahead of in terms of value creation. My sense is that this is a good opportunity in adversity to buy some sectors which are underperforming, just as a sector rotation and hibernation takes over.
Right. Okay, let's get in some BTST trades as well going. Kunal, list of mid caps or large caps?
So yeah, mid caps, 2 buy calls. The first one is upon BHEL, would anticipate this up move to continue for at least a day or two more. 114 to 115 as a target. Stop loss would revise higher to 106 for BHEL. And on the other hand, L&T Finance today has shown a very good short covering move. It's a bounce from the oversold indicators. So 130 as a target, stop loss at 120.
Right. Naresh, what's on your BTST list?
First is a buy on LIC housing, maintain the bullish stance, stop loss at 420, target of 435. Second is a buy on Indian hotels, which is reversed from the 380 mark. And the whole hotel space looks interesting. There's a lot of catch up of the last few sessions to be done by Indian hotels. Should ideally make a breakout move going forward. Stop loss at 384, target at 397.
Okay. Sun Pharma, I mean, it's like a flat line, honestly. You just have to draw a flat line, and that's how I think markets have moved. So much of analysis, so much of opinion that is not really having impact on the market per se. Kunal, this week Reliance saved the market, I think. And today Reliance is the one which is dragging the market down. Now HDFC Bank, the chips are down. Reliance seems to be reversing. IT is not in a leadership sector. The leadership in the market is not there, I guess.
Yes, that's exactly the point which I was trying to tell even yesterday. Even though the Nifty bounced 100 odd points, we are missing the zing from large cap stocks, which are the first ones actually to participate. Now, other than the sectors which you mentioned, look at the pharma stocks. Sun Pharma, Glenmark Pharma, etc. Most of the stocks which have rallied up higher in the last 1 week, even the likes of Cipla and Lupin, these stocks have gone to a correction. Auto stocks have also gone to a sideways range. I think except for Mahindra and Mahindra, there's hardly any stock which has even recovered from their previous highs for themselves. So when you have lack of sectors, lack of large cap stocks participating, every kind of a rally would get sold into. And I think that's exactly what we're seeing today for the index.
Right. Just looking at a couple of other stocks as well. So M&M Finance, of course, like Kunal highlighted, was looking strong. Tata Com has been quite the strong mover today. And then GMR Infra as well, Kunal. Quite interestingly, I mean, it's not many people want to trade this, but you can't deny the strength in the charts.
In fact, in the last 6-7 months, there have been a lot of these two-digit stocks which have actually found a lot of interest from traders. So, and you look at the last 3 months or 2 months of performance, there are so many stocks which have clocked 20%, 30%. For example, Suzlon, which has done exceptionally well, again, a two-digit stock. R Power has also performed quite okay in this kind of a span. So, I'm not sure whether it's the mid-cap and the small-cap fur which is spiking up higher. I don't track the stock as well as recommend to trade GMR Infra.
I think Jay was saying that Fairfax, which owns the Bangalore airport, they are looking at taking that public. Now, the Bangalore airport, in a sense, has some ownership of Fairfax. And if that goes public, I mean, GMR will benefit. Just think about it. I mean, what is the airport business? And GMR Infra, they had all the problems and they've separated the airport business out now. The airport business is like a business which is almost like a toll business, right? Every time you go to the Delhi airport, you have to pay a toll. Every time you drink a coffee also, the airport, the operator, they actually makes money. The traffic is increasing. With so many aircrafts which are going to be coming, airports are going to be the real toll station, so to speak, in terms of where the monetization will happen. And that's one of the businesses where the Adani Group is very bullish on. Yeah. And Adani Enterprises, in a sense, has really incubated a lot of airports right now, including a good old Bombay airport, old airport, naya to pata nahi kab aayega. But that's the way it is. I mean, these are businesses where you would say that, look, they're going to be play on India's growth. They're going to be play on air travel. They're going to be play on these multi-year assets which you create and the ring fencing which you do with the real estate around it.
And the large land banks.
Yeah. I mean, to give you a classic example here, just go outside Delhi airport and you see this AeroCity. Yeah. And the land actually is owned by the airport operator. Yeah. And you cannot value that land because that land incrementally is only going to go higher. I mean, the venture may not be, that area may not be.
And the ecosystem which is getting created at these aerocities. Delhi is a prime example of that.
Bangalore also they managed to create. That could be the reason why GMR has gone up today, but we'll continue our chat about airports and about, what's happening in terms of some of the PSU stocks. But right now, 45 seconds to go. You got to let the screen do all the talking here. BSE postpones Jio Financial Index exclusion to 29th August. I think this is technical in nature. I don't think it's going to have an incremental impact per se. Where is Jio Financial actually? 5% down yesterday. I think it was 5% down when I last checked. There you go. The price discovery happened at 260, 2 days 10% down. But the price discovery happened at a much higher projected price than what everybody anticipated. The projected price for Jio Financials was between 170 to 190. The price discovery happened in 260. So it has to come to the fair value, so to speak, in terms of really, finding the right level. But that's Jio Financials for you. 6 seconds to go for the markets, and then it's done for the day. Really flat. I mean, unchanged is the word. When 3 points on the Nifty, And for the Sensex, like a flat line. You don't see a market like this
It's
on
like
a
that
daily
historic
basis.
day, right, Kunal, when the Nifty Bank missed by what, 10 paise from its all-time high. But yeah, sometimes flat is better than bad. So let's see which way we head from here. For now, it's curtains down on this edition of Closing Trades.
LIC presents Dhanvriddhi,